of of this series on retirement planning, and part 4 is about personal pension plans in Kenya. How do you choose the best personal plan for you? In part 1 of this series, I we explained how retirement system works in Kenya. We looked at NSSF, occupational pensions, and the regulatory structure. In part 2, we calculated how much money you actually need for you to retire. And for many people, this number was much higher than you thought, much higher than you expected. In part 3, we broke down the investment strategies. We looked at bonds, rates, money market funds, rental property, SACCOs, and as well as businesses. Now we come to something very specific. And this video is especially for entrepreneurs, consultants, freelancers, business owners, or self-employed professionals. If you do not have an employer who sets up a pension for you, you do not have an employer who matches your contribution, then you must build your own retirement structure. You must work for your future now. So that's why today we are talking about personal pension plans in Kenya, and also known as individual retirement benefit schemes. How do you choose the best one, and how do you go about the whole thing? Part 1, what is an individual retirement benefit scheme? Let's break this down. So an individual retirement benefit scheme is a personal pension account that you open through an approved provider. It's not tied to your employer, though also if you're employed, you can still have that account to help you contribute some amount for your retirement. So if for this account, you decide 3 things: how much to contribute, how often to contribute, and when to increase your contribution. 3 key factors. So the money is professionally invested in government bonds, can be invested in equities, can be invested in money market funds or money market instruments, yes, funds, and other regulated instruments. And because it's invested, it grows over time. Unlike NSSF, which you don't have control over, for self-employed individuals, this is not optional, and you have total control on what to do with your contribution. Let's move forward and look at tax benefits under the Kenyan law. One of the best advantages of personal pension plans is tax efficiency. In Kenya, when you talk about pensions contributions, they qualify for tax relief up to a certain limit under the income tax law. What does this mean? This means that if you are contributing your money towards an approved pension scheme, then your taxable income reduces. What's taxable income? Taxable income is you pay tax, and you pay tax based on how much money you have. So people who have got a lot of money, that's their taxable income, they pay a lot of tax. People who have got a small taxable income, the small amount, they pay smaller amount of money. So if you're contributing towards a personal pension plan, that means that when your money was this big, it will reduce to this small amount, which means that the tax that you are paying for this particular amount is smaller than what you would have paid if you would not have reduced your money. So you are building retirement savings, but at the same time legally reducing tax. So you can be getting the same amount of money with someone, and they pay a lot of tax as compared to you. This is how people legally reduce tax. For higher income professionals, this is extremely powerful, so that instead of paying more tax, you redirect part of that money into your future. You are paying small amount of tax, but at the same time, you are building something for your future. This is strategic wealth building. Many entrepreneurs don't use this tool. Many people actually don't know that it exists, but I've come here to tell you that it's a tool that exists and you can use it to your advantage. Not because it's an people don't do it not because it's unavailable, but they don't know. They don't know. The Bible says that my people perish due to lack of knowledge. They don't know that this particular thing exists. Let's talk about contribution limit. There are limits to how much qualifies for tax relief. Currently, pension contributions qualify for tax relief up to a capped monthly limit or equivalent to an annual amount. Beyond this, it's not covered. You can contribute more than the relief limit, but only a portion will qualify for tax benefits. I don't have this exact amount because this video is not about that, but in our future videos, I'll break that one step by step so that you get to understand. So the key lesson here is consistency matters more than occasional larger deposits. So be consistent over a long period of time. A steady monthly contribution over 20 years is more powerful than having random large chunks of investing. Let's look at because now we are choosing a personal pension scheme. How do you compare the pension providers? Because there are many, I shall mention them. There are many in the market. How do you compare to get the best? Not all pension providers are equal. Just the same way, not all banks give out loans at the same interest rate. So when choosing a personal pension plan, consider the following four factors. Number one, performance history. How has it been performing? Don't just look at a good year, look at a spectrum, at a long period. Number two, fund options. Some providers will offer conservative funds, others will give balanced funds, others will give aggressive growth funds. So choose based on your age and the risk tolerance. Factor number three, the fees. Other pensioners will charge you a higher fees, others will charge you a lower fee. It's important for you to just understand the fees before you start investing in that particular plan. Then number four, the last one, governance and regulation. Ensure that the pension provider is licensed and regulated by Retirement Benefits Authority. Never invest retirement money in unregulated schemes. That is how people lose money. That's how people lose the entire of their saving of their savings for the time that they've been working. Let's look at steps how to open a personal pension plan. So opening one is simpler than you may think. Actually, it's a four steps, and so follow these steps. Number one, choose a licensed pension provider. There are so many. There are, for example, ICA Lion Group. We have got Britam. We have got Old Mutual, Zimele, Enwealth. This, along with many others, Cooperative Trust, Sanlam, and CIC Group. So choose one. Number two, complete application forms. This can be virtual or it can be physical. Step number three, submit identification documents, ID, KRA, all those. Step number four, set contribution amount and the frequency at which you shall be contributing that amount, particular amount. Step number five, select the investment fund option. Once opened, automate your contribution. Why do I always say automate? Because automation removes emotion. Emotion will destroy consistency. But once you automate, you remove the emotions and then you're able to contribute consistently. Now that we've done that, let's look at retirement planning for the self-employed. If you're self-employed specifically, how do you plan your retirement? Because when you're self-employed, retirement planning must be deliberate because you don't have an employer who will be contributing that particular amount of money for you. There's no employer matching your contribution. There's no HR department reminding you on what to do. So you must redesign your own system. So a strong structure might include a personal pension plan, SACCO deposits, government bonds, rental property, as well as business reinvestment. But this is the danger that people don't talk about. Many entrepreneurs always say that my business is my retirement. And I've always said that businesses can fail, markets can fluctuate, and industries can be disrupted. So your retirement should never depend on one asset. Diversify outside your business. How we are about to finish. So how to increase pension contributions strategically. As income grows, whether from different sources, pension contributions should also grow. And these are some of the simple strategies that you can use to increase your pension contributions. Number one strategy: increase contributions annually by a fixed percentage. Number two, direct bonuses or large contracts into pensions. You get some large amounts of money or bonuses, direct them into the pension. Strategy number three, increase contributions whenever income increases. And then strategy number four, avoid withdrawing when changing jobs if applicable. Understand the following. This is very key, that time plus consistency plus tax efficiency will give you exponential effect when it comes to retirement planning. The earlier you increase, the lesser pressure that you'll have later in your later years. So as we close, personal pension planning is not just for corporate employees. It's especially powerful for entrepreneurs, consultants, freelancers, and professionals that are building independent careers. Retirement planning is not just about age, it's about structure. And that marks the end of part 4. In the final part of this series, part 5, we will talk about corporate and workplace retirement planning. And that last part is specifically meant for HR professionals, business owners, organizations, and companies that want to build structure, retirement systems for their employees. Because retirement is not just personal, it can also be institutionalized. And when structured well, retirement creates long-term financial security, both for the employees and at the same time for the employer or the company. So that marks the end of part 4. I'll see you in part 5, where we shall be looking at corporate and workplace retirement planning. So thank you for watching up to this time, and I'll be seeing you in the next video. Stay tuned and thank you for watching. Bye bye for now.